Welcome. Today we're going to talk about selling final expense to a growing marketplace. When we talk about a growing marketplace, we're talking about the senior market. It's expected that there will be more than 76 million individuals aging into the senior market between now and 2030. In fact, starting in 2010, more than 10,000 individuals a day from the baby boomer market, those individuals born after 1946, started aging into this marketplace. So what are the primary concerns the individuals in this marketplace have? Well, their primary concern is doctor's expenses, hospital expenses, prescription, and recovering at home after a procedure, or not leaving a financial burden to their family. In other words, final expense. So when we talk to these individuals, we want to talk to them about the things they use the most in the order they use them. The question I would ask them is, when you think about managing your health care expenses, are you more concerned about your doctor's expenses, hospital expenses, prescription, recovering at home after a procedure, or not leaving a financial burden to your family? Whatever their answer is their dominant buying motive. And then you repeat the question again until you get done with each of these needs. Their answer will tell you what concerns them the most, and that gives you the opportunity to help them meet those needs. So if your client does not have final expense insurance and a death occurs, what choices do they have? Well, they could rely on their family or friends. They could spend down their personal assets, including their savings, which would leave the surviving spouse less money to live on. They could borrow money, or they could do what the baby boomer generation is accustomed to doing, and that is transferring financial risk to an insurance company. This group of individuals has a long history of experience in life. They have lost houses, bought houses, had jobs, lost jobs, had kids, lost kids. They understand the value of transferring risk. So for them to transfer risk to an insurance company is something that's more normal than abnormal. The way we can help our clients is to encourage them to use discounted dollars to pay for future needs. In other words, these are predictable expenses. We already know they're going to incur these expenses. At some point, one of the spouses is going to pass away. We already know they're going to incur these final expenses. They can set aside premium dollars today to pay for these future expenses, and these premium dollars will actually be discounted dollars compared to the dollars that they would have to use if they didn't have it. So how do you address this need in a growing marketplace? Well, the way you address these needs is to start talking to your clients about the financial hazards that the death of a loved one will bring to them. And there's two primary financial hazards. The obvious one is the final expense gap. In other words, what money will they use to pay the final expense? The other financial hazard is the reduced income, and we'll talk about that in a minute. So when we think about the financial hazard of spending their savings on final expenses, if they don't have a final expense insurance plan, they'd have to borrow the money, they'd have to use cash, which reduces their ability to have that money available for future emergencies, and they don't have the resources to replace that cash. They're not working anymore. They might have to have their family pay for it, or you can reposition money that they currently have in their monthly disposable income and put into a final expense insurance plan. So what are some of the responsibilities of final expense? Well, let's look at what some of those costs are. Some things that bring expenses pre-funeral include ambulance, paramed fees, hospital emergency room charges, physician fees, and other unreimbursed medical expenses. Some funeral expenses your client has to consider at a time that could be the most emotionally devastating period of their life would be to spend money on professional service charges, transferring the decedent from where they passed away at to the funeral home, having a viewing facility for family and friends to come in, other preparations like the suit and clothing, flowers, the hearse, a casket. There's expenses like the cemetery plot, the headstone, what engraving they're going to have on the headstone, opening and closing of the casket, and embalming. And all these decisions have to be made at the most emotionally devastating time in your client's life, should they have to worry about the money to pay for that. Then after the funeral, they have to start thinking about probate, miscellaneous estate expenses, other expenses, for example, family, friends, and relatives that come in from out of town, unpaid debts, credit cards, and other miscellaneous expenses. Would it be nice for them to be able to have the funds available to meet those needs so they don't have to worry about it? Then the other financial hazard that's still there for the surviving spouse is the reduced income at their spouse's death. When the spouse dies, if the male's 65 and the wife is 62, you fast forward 5 years and the husband passes away, then the wife has to worry about making a decision to either take her husband's Social Security, which is usually higher than hers, and giving her Social Security up, or keeping her Social Security, which is usually less. The reduced income can be financially devastating to the surviving spouse, often leaving them dependent on other family members or government program, in other words, welfare for help. So if the male is 65, we know that there's 3 things that the person retiring is going to do almost without exception. They're going to sign up for Social Security. They're going to automatically be enrolled in Medicare. And 80% are going to buy a Medicare supplement anyway. The reason they're going to do that is because if the male is 65 and his wife is 62, usually younger, they have been spending their money in their monthly disposable income for the last 30 or 40 years for health insurance. They're spending between $8,000 and $12,000 a year. Even if they have group coverage at work, they're still paying for dependent coverage. So when they turn 65 or they retire and they sign up for Social Security and they're automatically enrolled in Medicare, they're going to buy a Medicare supplement 80% of the time by repositioning the money they're already spending on health insurance and move that over to buy the Medicare supplement. That's the time you want to package a final expense product when they've already got the premium dollars in their monthly disposable income. And when you do that, the spouse is going to need her own major med plan, which includes critical illness. And when she turns 65, she'll age into Medicare. But let's look at the finances. Nationally, the average Social Security retirement check is $1,609. The average retirement income from work is $1,200. With the wife's Social Security as an average of $900, you can go to socialsecurity.gov and check these figures. They've got an average monthly income of about $3,700. If you fast forward to age 70 and the husband dies, the wife will choose to either keep her husband's retirement income from Social Security of $1,200, or she'll choose to keep hers of $900. Which one do you think she'll take? Probably the $1,200. She'll keep that, right? That means she's also making a choice to give up $10,800 a year in income. That means the first year her husband passes away, not only does she have to deal with the emotional devastation and the loss of her spouse, she has to manage the first year with $10,800 a year less income. And over a 10-year period of time, that's more than $108,000 that she's choosing to give up. So the dominant buying motive, the need that we know exists, the predictable buying behavior that we know is going to occur, is to be able to supplement the income that is going to be lost at least during the first year her spouse passes away. So what's the solution? Well, a plan that would provide a source of income to the surviving spouse to sustain that normal lifestyle. In other words, put her in a position so the things that have become staples do not have to become luxuries. So when you're talking to your senior client, it's not so much a sales script as it is a matter of asking questions and get them to start thinking. Some of the questions you can ask: or have you or someone you're close to ever been responsible for making funeral, cemetery, or cremation arrangements when someone passed away? How did it go for them? How did it create any financial problems? Who will be responsible for your arrangements upon your death? Is that person financially prepared for such an emergency at such an emotional time? Do you have any children, grandchildren, or a favorite charity that you'd like to leave any money to upon your death? Upon your death, does your spouse have enough savings to protect them against the immediate loss of your income? How much do you expect your funeral expenses to cost if you died today? How much do you think the same arrangements would cost if you lived to age 80 or 90? And you can even use the inflation calculator to figure this out. If someone is 65 today they would have to have $8,500 for a funeral at today's prices. But that projects out to $18,624 if they lived to age 85, and $27,568 if they lived to age 95, figuring a 4% annual inflation. So do you realize that your bank accounts and assets are not available to your children immediately upon your death? Unless you have a joint account, which opens a whole other set of problems. Are you aware that there are final expense policies that can be paid with one single premium, an annual payment, an affordable monthly premium? Do you have any health conditions that have caused you to have been turned down for insurance coverage? Who would be the beneficiary of your insurance policy? If you don't take out a final expense policy, what alternative plan will you use for your family? So let's look at some of the features of a final expense program. The benefits do not decrease. The premiums do not increase. The policy cannot be canceled because of your client's age or health. They get protection from the very first day their policy takes effect. The benefits are tax-free, and it's a simple application process. So what are some of the benefits? Well, the final expense program can be left to their spouse, to their children, to their church. It can even be left to their favorite charity. Of course, it can be used to pay their final expenses. It can provide income to the surviving spouse, and you can leave funds behind for special needs. Without a final expense policy, what are your clients' choices? Well, they can depend on their family and friends. They could spend down their personal assets and savings, which means they don't have the money available for future emergencies or expenses, and they don't have the resources to replace those funds. They could borrow the money, or they could do what they're accustomed to doing, and that's transferring their financial risk from themselves to an insurance company. Remember, they've been doing this their entire life. They've had houses and lost houses. They've had jobs and lost jobs. They've had children and some have lost children. They have a whole lifetime of experience. They understand the value in transferring the financial risk from themselves to an insurance company. So what's the solution you're going to talk to them about? Well, a plan that will provide a source of income to the surviving spouse to help sustain her or him in a normal lifestyle. In other words, the things that have become staples in their life do not have to become luxuries. Today we talked about selling final expense in a growing market. If you have any questions or comments or you'd like more information, you can email me at lloydlofton@yahoo.com. If you have a case-specific question, you can call me at 865-776-7632.